start admitting people, and then I'll admit the lobby. Hang on. So, oh, here we go. Morning, Angela.
Morning,
Morning,
Steve.
John. Morning, Henry. Morning, Derek. Morning, Peter. Thanks for joining. Morning, everyone. Good morning, morning. Morning, Shay. Morning, Peter Cameron Brown. Thanks for joining. Good to see you. If you've just joined, if you could mute. Yep. Thank you, Peter. Sorry. Let me get Phil. Morning, Phil. Thanks for joining. If you've just joined, if you could mute, please, that'd be great. So that'd be good. And Philip, good to see you, Philip. Thanks for joining. Okay. Right. I will monitor the lobby. Morning, Con. Good to see you. I'll monitor the lobby, and welcome to this week's Pension Playpen Coffee Morning. Delighted to have Matt Setchell on and David Bird. I will say you're from Octopus Energy, but you're a division of Octopus Energy, but I'll let you explain all of that, Matt. But number one, thanks in advance for presenting today. Number two, in typical fashion, Henry and I would like interaction. So if you'd like to ask any questions, please raise a hand or put some comments or links in the chat. Before we start, we are recording. So Angela, Con, John, Derek, everybody's happy with recording? Perfect. Okay. So without any further ado, Matt, I'll pass over to you and David, and look forward to your presentation.
Great. Thanks, Steve. Hope everyone can hear me. And thank you so much for asking us to present, and delighted to meet everyone here today. I'm going to try boldly to, I've got a few slides just to frame the conversation. I'm going to try and share that without destroying my, oh, where are we? Okay, it's not coming up with the, let's try this one.
Perfect.
That doesn't look like it's going. I don't know why it's got a notes pages on there as well, but you get to see ahead. Is that clear enough for everyone? It's a bit small, isn't it?
It's like it's in full size mode for me, so that's fine. I think.
Is it? Okay, maybe it's
everybody else see that? Derek, Con, everybody can see that? Yeah. Okay.
Cool. Okay. Well, so by way of a quick intro, I'm Matt Setchell. In 2010, I started the renewables fund management business within Octopus, which is now called Octopus Energy Generation. Octopus Energy Generation is 100% owned by Octopus Energy, which some of you might be aware is the global energy tech and retail gas and electricity supply business. I've got a few slides on who we are as a fund management business, but I'm assuming you don't want to listen to me spout on about our business for the main part. So these are the key takeaways for you to have about Octopus Energy Generation. First of all, we are a specialist fund manager, only doing energy transition investments, and we do lots of it. So with a big specialist team, we have about £7 billion of energy assets under management, a team of 160 located across London, Dublin, Paris, Milan, Frankfurt, New York, and Singapore, and investments across 21 countries. And finally, we manage money for institutional investors from around the world that invest into our suite of funds that deliver the wide spectrum of risk and return within that sort of energy transition opportunity. So as a fund manager, we are, I think, completely unique as being part of a broader energy group called Octopus Energy. So most of you will probably know Octopus Energy as a UK retail energy supplier. It, from a standing start in 2016, has become the largest in the UK in terms of supply of electricity and gas. But it's really a technology company at its heart. That does energy, and its sort of strategy is to drive the electrification of the economy globally. And it is one of the few companies in the UK that is a climate tech unicorn. It achieved $1 billion valuation several years ago now, is now well on the path to becoming a decacorn, and it's proven that it can scale technology and a retail brand all the way around the world. But you're not here to hear about Octopus Energy. You're here to hear about a little bit about Octopus Energy Generation, which is the fund management and what we can do within the energy transition space. So as I say, this is the part of the business within Octopus Energy that I co-head. It's 100% owned by Octopus Energy, and we have about £7 billion of energy assets under management, all owned by pension and insurance investors from around the world. A bit of background: I started the business by taking a balance sheet investment in a startup solar developer called Lightsource. Lightsource has since become Lightsource BP. And is probably the largest solar developer globally outside of China. Since starting investing in solar development in the UK, we've established an experienced team investing through the life cycle of renewable generation projects and across all technologies. So that includes onshore wind, offshore wind, biomass, and batteries. We've also expanded to become an international fund manager, both in terms of where we invest and also where our team is located. As I'll come to shortly, we don't just invest into renewable generation, but cover the wider energy transition in all main markets we operate in. Now, it's normally this time, and I'll let Steve lead if there's any questions. It's normally this time I like to preempt at least two questions that usually come up from people that have only just hearing about Octopus Energy Generation as a fund manager. The first of those is, well, does Octopus Energy own the renewable projects, or do we supply the electricity generated to the retail customers from, the wind and solar that we generate? And the quick answer is no to both. So the renewable generation projects are managed by us as a fund manager and owned by institutional investors within funds predominantly. And given our investors want the highest price for the electricity generated, and Octopus Energy Retail would like the lowest, we don't generally end up selling any of our electricity to the retail part of the group. The second question is, are you the same as Octopus Investments? Again, the answer is a resounding no. Octopus Investments provided their balance sheet sort of startup capital to Octopus Energy, which is why we share the same name, and they are still a minority shareholder in Octopus Energy. But we are a completely different, separate fund management business. I won't dwell too much on the team, other than say we, as I said already, we're a very large team of over 150 that only invest across the energy transition. Because we are deep in the sector, across the full value chain, we have experts that understand construction, development, energy prices, how we contract our generation into the market to sell those electrons, as well as all the core functions you'd expect to see in a sort of fully integrated, independent fund management business. I'm going to move to sort of the heart of sort of the slides, which is actually what is this opportunity we're talking about. So I've mentioned a few times energy transition, and that term itself can mean different things to different people. This slide is how we as a business think about it. So at a headline level, the energy transition is a £212 trillion investment opportunity between now and 2050. And for investors, that means a broad and growing universe with some very different risk and return characteristics across it. To my mind, the energy transition can be defined broadly as the build out of lots of renewable energy generation, the electrification of pretty much everything, and where it's not possible to electrify, to decarbonize and deliver low carbon outcomes in the most efficient way. So on the left-hand side, we have what could be described as kind of traditional renewable generation projects. So you have onshore wind, offshore wind, solar, are the lowest cost generation in pretty much any geography. Therefore, they will underpin the bulk of the energy generation around the world going forward. However, the energy system doesn't stop at generation. It needs to get to the end user, and the inconvenient truth about renewable generation is that it turns off or on, depending on the weather. And the right-hand side massively oversimplifies the rest of the energy transition, but it speaks to this sort of electrification of everything, from transport, homes, industry, as well as that sort of inherent challenge of intermittent generation, which means we will need to invest into grid, electricity storage, and alternative fuels. All of this together creates a massive range of opportunities for investors to find strategies that fit their specific requirements. To give you a relatively high-level flavour of the range of risk returns, this slide sets out broadly how you might think about allocating within that energy transition universe. So the bottom left, low risk, low return investments are the renewable generation projects. This includes some construction, but once operational and with long-term contracts for the electricity, these projects become what are effectively annuity, inflation-linked cash flows over the very long term. We then move up into that sort of broader energy transition, where we will still be investing into infrastructure assets, but also companies that deliver this. It includes proven technologies that can obtain attractive contracted revenues again, but in areas that have not yet scaled to the same extent that wind and solar have. An example of that might be ground and air source heat pumps. So they're proven and relatively simple technologies that are currently scaling up. This can deliver target returns of sort of 15% plus. And then finally, at the higher risk end, we invest into developers of renewable generation. Those are the companies that find land, get planning permission, sort out grid, in order to get those projects up to the stage where they're ready to be built. Portfolios of developers should deliver 2 or 3 times your money over 7 to 10 years. There's also a huge opportunity to invest into the technology that will be required to get us to net zero. We're looking at Series B investment rounds targeting 20 to 25% returns. So hopefully you'll get a sense for how the broader energy transition opportunity can offer different investment solutions for investors, from that sort of lower risk, attractive cash yield portfolios to higher growth mandates. Given this is all we do, we cover the sector really deeply and across all of those different risk profiles and geographies. And we've created a suite of products and solutions that give investors a single access point to the full opportunity. Going back to the early schematic in this slide, I've added some of the funds we manage and where they fit into the energy transition. So on the left-hand side, actually on the development side, it's currently an SMA, so it's not open at the moment to everyone, but we've got a team that invests around that. So the Canadian CPP invested 220 million into a fund, which is just for them, where we deploy that team to invest the money into European developers. So that could be onshore wind, batteries, and solar in 20 or 30 million pound checks. We then move into sort of core generation. You've got our flagship fund in there, which is called Sky. It's through 2.3 billion pounds of committed capital. So 60% of Sky is into that sort of generation, so high cash yield, lower risk, but then it's also got a little bit into some development, which increases returns, and it's got a little bit of the energy transition that also boosts return as well. We've also got investments in that sort of core bucket into an offshore wind fund. And then finally, you move off into the other side of the energy transition, which is everything but the generation, which is where we've got a fund called Energy Transition Fund, which is targeting higher returns by investing in those companies and infrastructure that deliver that broader energy transition mandate. And then finally, on the right-hand side, we have that sort of Series B climate tech fund that I mentioned earlier. So you bring all that together, and you can see that by either combining it for investors accessing those funds individually, we can create different risk returns that give investors that full access. And indeed, one of the semi-liquid product I'll get to shortly is a umbrella product that sits across those multiple funds, giving even more diversity and a balanced risk profile. This slide gives a bit more info on each fund. There's lots of words in here, so rather than read through all this now, I'll obviously be delighted to share more detail on all of the current funds if you'd like to hear more in the future. It might just be worth mentioning that the Sky Fund, which is now about 2.3 billion of committed capital, was cornerstoned by Nest, who have obviously the auto enrollment scheme, who have continued to invest since inception in 2021. We've also received investment from another sort of master trust, Smart Pension, across several of these strategies. And where relevant, these funds have been researched and supported by most of the consultants. I think I saw a question come up, but I then lost it again. Steve, shall I try and answer those as we go, or will you field them?
It's entirely up to you. You or David can answer as you go, or we can do it at a Q&A at the end. Yep, it's entirely up to you.
Well, why don't I have a go to break this up a little bit? So do you have leverage in the annuity investments to enhance IRR? Yeah, we don't use lots of leverage in there, and we can use leverage. So as you can imagine, given there's a lot of contracted cash flows in those generation portfolios. So this is where you might have a large scale solar farm in the UK that has got contracts for differences. Therefore, over the next 15, 20 years, effectively your power price risk has gone away. Therefore, you're taking a solar production risk, and you can mitigate that through having forecasts and also having a large enough portfolio. And given that, as I say, you're getting that annuity cash flow, which is inflation linked, and banks are very happy to lend against that. At a fund level, we don't take a huge amount of leverage. So Sky Fund, for example, I think said a sort of 30% leverage. We've got our investment trust. David can correct me on this, but I think that's around sort of 40% leverage. And the leverage that might be at the fund level, at the individual project level, that might go up or down. So certain projects might have more leverage than others, to the extent that you can the banks are more willing to lend and you get cheaper debt on those, and you might have zero leverage on other projects where perhaps there's less contracted revenue. But even where we are putting debt into projects, we don't put a huge amount into that. You can clearly add more if you've got a higher risk return appetite. Does that answer the question from John? I will. I'll just pick up. Thanks.
Yes, thank you. That's great.
Do pension funds invest in the funds separately, or do they portfolio across the funds? So it's a bit of a mix, actually, and we'll come on to one of those sort of umbrella funds, which actually is a separate fund, but invests itself across all those underlying funds. For the most part, frankly, pension funds will be investing into those separate funds separately. So they'd either invest into Sky or their energy transition fund or Vector. Funds like Smart, I think has been announced, have invested across different funds in one go. So it hasn't gone into an umbrella structure itself, but they've gone into Sky and then the energy transition fund. So it depends on where they want to get to on the risk return mandate. And they all have their sort of different attractions depending the appetite from investors. So Sky is an evergreen fund, it's delivering a net 10% type return. Certain investors don't like evergreen, so they might want a slightly higher return, and therefore, or they've already got enough exposure in that sort of broad energy generation. Energy transition fund could be really attractive for those because it delivers a 15% target return. It is a fixed life fund. So once investors get an idea of where they sit in that risk return profile, then we can have a really sort of transparent conversation in terms of where that fits. And indeed, we'll come now to the sort of the semi-liquid product, which gives that broader exposure across a lot of these funds itself. If I can scroll it forward. Here we go. So as I say, what I'd like to talk about now is how we are innovating to create new funds that actually aim to unblock some of the challenges and complexities that makes it difficult for some investors to access both private markets and the energy transition opportunity. Before getting into the weeds of what that fund looks like in terms of structure, I thought it'd be worth sort of showing what they get from day one. And it's really important that this is actually what's unique about this is from day one, any investor coming in comes alongside existing investors, blue chip institutional investors, and into a very large, very well diversified portfolio. So investors will get this sort of balanced exposure to the broader energy transition opportunity I've just talked about. It already has this portfolio of 48 investments across 12 technologies and coincidentally 12 countries. And indeed, I think that's a little bit out of date. I think we've added since then. And there's a weighting towards that sort of operational and contracted wind and solar, but with allocations to construction, development, and energy transition technologies to get that return up to about a 10% net return. And so that's where investors' money will go, but the innovation is really around how we've set this up to reduce the complexity and increase the liquidity, given it's a semi-liquid fund. So this slide starts getting into the operational plumbing of the fund. I think it's important to note that the cornerstone investor is a UK corporate DC scheme. So they invested in April, May, 175 odd million pounds. What's slightly different about this DC scheme is they have a significant amount of self-select to the scheme, which means they had their own requirements. This meant that the fund itself, this umbrella fund, was set up to solve for their challenges. But in doing so, we believe it's sort of unlocked access to a much wider member base, and hopefully a broader pool of investors. So the fund, again, I won't read through all the detail on the slides. So the fund provides monthly valuations and monthly liquidity. That's aligned with payroll. The 10% liquidity, which is also a month and also rolls to a quarter, and 20% over a year. Instant drawdown. So if you typical private market funds, if investors commit their capital, they then have to wait for those funds to draw down on it. Here, investors don't commit and then wait for over the next year for that fund to draw down on it. They get day one access to the portfolio that I've just shown you. It's platform ready. It's currently on the LGIM platform, and we're in the process of rolling that out wider. Quick settlement. So again, sort of no requirement for advance notice to redeem. It's a T+4 settlement. And for DC schemes, to the extent it's relevant to anyone in the school, it is fully compliant with permitted links. So what is it? So it's Octopus Sustainable Growth Fund is actually the shorthand version of the name, otherwise referred to as the semi-liquid fund at the moment. This is not probably the forum to get right into the weeds of exactly how this is done, although I know David on the call will be desperate to share some of that detail if the questions come up. I'll also be very happy to set up follow calls for anyone who does want to get into that detail. However, this slide gives a high-level summary of the fund. Some of the key takeaways you might want to take along from this. It is an evergreen fund. So in other words, it will remain open for new investments and exits with no end date. We have set this up as a non-UCITS retail scheme fund of alternative fund structure, or a NERS. This is a UK fund structure that has got FCA authorization, requires, and we've got FCA authorization. For those not aware of the structure, think about it as achieving everything the LTAF can do, but without some of the LTAF's limitations. The FCA have given this fund a sustainable focus SDR label, which is kind of the UK's equivalent to an Article 9 fund. In the process of getting the UK DC scheme cornerstone investment, the fund also went through a Mercer review process. How the fund delivers on that liquidity, so 80% of the fund will be into private markets, both existing funds and direct and co-invest. And the remaining 20% will be in listed equities. The listed equities is an actively managed portfolio of companies that are aligned to the sustainability objectives, but have perhaps a broader interpretation, which enables us to have a much wider investor universe and to ensure we are comfortable with getting the liquidity that our investors will require out of this fund, or could require out of this fund. To give you an idea, that portfolio currently has over 40 holdings with no investment of over 5%, of the portfolio. And some of the larger positions will be names you'll recognize, like Schneider, ABB, and Siemens. Finally, on sort of ESG and impact reporting. So I hope it's coming across. When we invest on the basis of delivering an attractive risk-adjusted return for our investors across all of our products. However, alongside this financial return, investing into the energy transition also has a very tangible, positive impact. We try to find ways to make this impact story much more engaging for underlying members and indeed trustees. You can get bogged down, frankly, in KPIs that for most people appear fairly academic. So we try to make things more real and relevant. We also offer to engage with our LPs at the investor and trustee level, all the way through to the members. And we work with our investors to help them with a narrative that supports how they wish to communicate with their underlying members. And this goes beyond sort of just the ESG metrics that sort of flashed up on this slide. For example, sorry, with the increased focus on UK productive capital, we can ensure all of our investors have both the stats and perhaps the interesting stories that aligns them to Mansion House themes as well. So this final slide is the obligatory wrap-up summary, which frankly just repeats everything I've just said. So I won't do that to you. However, I would clearly be delighted to open this up to questions across anything I've covered or more. And I'll stop sharing so you don't just have to look at that slide. I say confidently. Stop sharing. Here we go. So I've seen a few more questions come in. I'll pick those up, and then if other people have got more, can you give an indication of the current yield of the semi-liquid fund? Well, the first investment came in April. David, where are we on yield on that?
Yes, well, in terms of what's actually coming out the top, actually at the moment, because the cornerstone investor has this primarily allocated to the growth stage of their sort of default scheme, they are in an accumulation share class. So in terms of cash yield being paid out, we're not doing that. We can easily set up an income paying share class. And the sort of cash yield there, if you think about the way Matt described the portfolio mix, those sort of core and core plus renewables projects are typically, so Sky and the Vector funds have a lot of those. Those funds are targeting a cash yield of sort of 7 to 8%, but they're only about 2/3 of the portfolio. The equities have got slightly lower dividend yields. So all in all, if we were to set up an income share class tomorrow, I'd expect that to be paying out somewhere between sort of 5 to 7% in terms of running cash yield. We are obviously targeting a 10% net return, so there's a significant capital growth element in that. If I look at sort of what we've done over the sort of 5 months or so since we've been set up, the unit price last I checked was somewhere between 102.5 and 103 pence. And that's after having sort of gone in at 100, but with a little bit of day one setup cost as well. So we're probably very slightly behind the sort of annualized 10% in the last 3 or 4 months. But obviously a lot of these projects are got lots of upside potential from there. So hopefully that answers the question.
There's a question in here about prejudice against Evergreen as a place to recycle unsaleable assets. It's not something we hear from investors, and so there's a bit of a journey here for Evergreen. So we were quite early with the Sky Fund, which is Evergreen. So that's the one that was cornerstoned by Nest in 2020, 2021, and I'd say that the first conversations on the back of that, we probably had 50% said, look, really interesting fund strategy, Evergreen, we haven't done much in there yet, keep track of it. I don't think it was coming up that it's a place to park unsaleable assets. I think it's more just that's used to normality of having a fixed exit so that they've got visibility in where that comes through. I think in the last probably 2 years or so, we're seeing much wider investor understanding of the attractiveness of Evergreen, and not just in the UK. This is not just a UK DC scheme. We've taken on a very large ticket from a Dutch pension scheme more recently. So all the European, Japanese, and UK schemes are getting their head around Evergreen and are finding the attractions of that, both for the ability to come in and come out, and clearly where you have larger and larger funds, you've got better idea of where you're going to get that liquidity fund. So on the whole, it's actually more positive, and a lot of our funds going forward are going to be Evergreen because that's where we're seeing actually most investor demand.
Matt, there's a question from John. I don't know whether you want to ask the question, John, but for retail, I mean, looks like retail customers are talking about dollar and euro pricing for
I was
retail
just saying
customers.
I was
Yeah,
just
go on,
saying
John. Yeah.
from a marketing point of view, you're an international company. Can we price some of the units in pounds or in US dollars? The individual retail customer can't do the hedging necessary, but it would simplify and make life easier to get to across what are wealthy but still technically retail customers.
So for the semi-liquid fund, we haven't done anything other than a pound sterling sleeve. For Sky, they've definitely done a euro sleeve. I think they might have done a dollar sleeve as well. I'd have to remind myself on where they are on that. I know they're planning to. So there is ways to come into that. Is a different product. So it's a private market product which isn't set up in the same way that the semi-liquid fund has been set up for well, we're not expecting direct to retail, but through wealth intermediaries.
Well, how big would a fund have to be worth your while?
To start looking at a dollar and euro sleeve on this, to be honest, we'd have to look at it. We haven't seen investor demand for that at the moment. It's a type.
That's because the regulator doesn't allow advisors to do it.
Oh, they're right.
Okay, they're sophisticated when they do it. If it loses money, they become retail overnight.
Yeah, that does sound familiar. It'd be very interesting to pick that up and to understand where you think that demand for that is from the presumably is it the UK wealth universe?
Yes, I have more than 100 million of that available.
I mean, talking about the UK, Matt, one of my questions was going to be, obviously, a lot of the presentations about institutional investments, and that's where the big ticket money is. Is there a drive towards retail in the UK? It's a mature market, a big market with, pensions, with master trusts, with SIPs, with ISAs, that sort of stuff. Drawdown is and will continue to be quite chunky business. Are there retail evergreen drawdown funds that you think could be decumulation? Is there a big market for you guys there?
I think there's a few answers to that, and David's quite well placed to answer some of that. But if I started off, retail, how we're thinking about retail on certainly the semi-liquid fund is wealth. So I don't think we'd be going out marketing directly, but we are talking to a lot of the intermediaries, both at a sort of the wholesale retail, so the banks, but also further down into the sort of the wealth manager world as well, and which I think this product works really well. But we won't be selling that directly to those end retail customers, if that's where the question is. I think what's interesting is clearly retail investors have for a long time had access to renewable projects and funds through investment trusts. We manage an investment trust called Octopus Renewables Infrastructure Trust, ORIT, and like all the other kind of yield-focused investment trusts, and I'll put a caveat on that because we've just launched our 2030 growth strategy. That's trading at a large discount to NAV. So you'll see that across the broader investment trust landscape. Clearly, that gives retail investors direct access to a portfolio of energy generation projects in the same way that we've just talked about today. And indeed, it gives access at a 30% discount. So what was launched as a 5% plus dividend yield is now, I haven't looked recently, but I suspect is a sort of 8 to 9% dividend yield on the same assets that we are investing into the private market funds.
And is that fund? I'll come to Henry in a minute. Is that fund on various platforms that we know and love, like Hargreaves Lansdown, or AJ Bell, or Kilter, or I don't know, Transact? I don't know. What platforms are you actually on?
Well, I own it on Hargreaves Lansdowne. I haven't looked on the other platforms. I suspect it is.
Yeah, so Orit shares are, because they're London listed, and even with some of the sort of headaches that some of the platforms had with Consumer Duty in the last year or so, Orit shares are available on Interactive Investor, AJ. So Hargreaves, Interactive Investor, and AJ Bell are all in our sort of top 10 or 15 shareholders actually. So it's widely picked up by retail. The semi-liquid fund currently is not on those sort of direct to retail platforms. But yeah, Orit certainly is on pretty much any one I could name of those execution only platforms.
Okay, cool. Thanks. Henry, do you want to?
Yeah, one of the things I keep hearing about is the difficulty with things like renewables and getting the energy in the right place at the right time. I think you mentioned that in your presentation. We don't seem to have the connectors which to get the stuff around the country and around Europe that we should have. I mean, I know people who are trying to get geothermal out of Iceland and to the UK, and it's just not happening. Is there a market for connection as part of what you're doing?
Yeah, absolutely. So the Sky Fund owns a grid business. To your point, it's called an IDNO. So it basically does the last mile of grid. So typically connecting the transmission network and distribution lines, and then adopting basically wires into new data centers or new housing developments or new renewables. It's not at the sort of big backbone of the grid that is needed and being reinforced to get the green electrons from Scotland, where there's lots of wind, and down to England, where the demand is. But it's playing into that general theme that there does need to be more wires to get the green electrons flowing around. In the past we have looked at interconnectors, so they're the cables that connect UK to other countries. Again, these are very big tickets. It's not to say we wouldn't do it in the future. The big tickets, sort of single asset risk, they come with certain complexities. So we haven't done that yet. On the whole, you'd find so the investment opportunity around those bigger sort of bigger cables and wires is typically owned through the utilities. So SSE owns a very big grid business, for example. So if you want exposure to that, is in there. I don't know of many funds that are focused on that. But we have exposure to it, which is the way we want to. And clearly the other part of it, so, and this would be more where Octopus Energy would point it, is that some answer is well, one answer, which we're not in the camp of, which is do less renewables and do more coal. Clearly not. I think you do need gas in the energy mix as a backup. Then there's like do more wires, get the electrons that you are generating and where it's lowest price to produce. And then there's actually when you're just manage those electrons better where you've got demand. So that's sort of demand side flexibility and work out how to store it. So this is where it comes into that sort of wider energy transition opportunity set. So we invest into large cell grid connected batteries, for example. That's not going to solve all the issues you flagged because it's relatively shorter term storage. 2 to 4 hours would be the sweet spot. Some are less than that, or a lot of less than that. But it plays into that flexibility trends. And then if you start thinking about the use of alternative fuels such as hydrogen or sustainable aviation fuels, again, they provide means of ways of converting those green electrons into alternatives that can be stored.
Well, thanks for that. Although it does sort of reinforce my worry that we're not getting the stuff from Scotland down here in the UK into the south and so on. And I do hope we get some more investment in connectors. If we're not too
There's a lot of upgrade, and these things that take a long time. So there's been a huge amount of investment into that connection between Scotland and England that will be rolled out over the next 5 years or so. So it is being unblocked for sure. So you're seeing a lot of noise out there at the moment about wind farms who is windy and yet they can't get the electrons down here. That won't be solved completely by these upgrades, but it will sort out a lot of the issues.
Thank you.
And on the question of wind farms, Bob Compton's just mentioned, why does Trump suggest wind turbines are a waste of time?
Well, Trump says a lot of things. Everyone's got different views. I mean, I find it unhelpful to be a zealot on either side. Actually, if I'm honest, I think you've got to be quite pragmatic in terms of what is an ideal energy solution. I suspect when Trump's talking to some jurisdiction where he's got renewable energy plants and manufacturers, he's probably saying less. He's less forthright in terms of how bad these things are. I don't know. He hates obviously offshore wind. I don't know where that comes from, other than it spoils the view from his golf course. Inherently, I don't know. It is, renewables is quite bifurcating, and I mean, calling a spade, the more populist agenda is points away from it, and we're seeing that same for reform in the UK. The economics make sense. So from a financial return point of view, it makes sense. As I said at the start of the presentation, onshore wind, offshore wind, solar in any geography is typically the lowest cost of generation. So it's an inevitable march towards having more renewable generation. It's going to have a few bumps in the road because certain people are going to be resistant to that. And there's certain challenges we just talked about, which needs to be solved, frankly, around, how do you make sure that you've got enough backup when it's not windy or sunny? And there'll be people who are trying to work that out now, and there'll be investment in other parts of the grid and in batteries and other bits and pieces. But also, I'm not a zealot in terms of the whole, you need to make everything green tomorrow, because practically that just doesn't work. So you do need some backup. Hopefully you make the backup as green, as low carbon as possible. But if we have some gas generation on standby or doing 10% of the energy mix, that's perfectly sensible. Clearly you do nuclear as well as zero carbon, but the UK government doesn't seem capable of getting that up and running anytime soon.
I had got one other question. That's, I am currently in Slough, which is the sort of home of data centers in Europe, certainly in the UK. How do you see data centers and their thirst for power developing in the UK? And are you behind that kind of thing as well?
David, do you want to have a go? I've been talking. We can talk about energy transition.
So there's a couple of bits of that. So I think the growth in power demand from data centers is something that is only going to increase the need for us to build a lot more renewable energy a lot more quickly to power them, and that's something that's not just relevant in the UK. It's certainly relevant in the US. And actually, if you look at the listed portfolio that we have as part of the semi-liquid fund, some of the companies they are investing into or that we're investing into in that liquid piece is in the companies that are going to deliver sort of more and more efficient computing power into those data centers to increase the efficiency, and I mean that demand isn't running out of control, but we're still going to need to build a lot more cables and a lot more generation. So it supports, I guess, the core of what we're doing on getting green generation built. It also supports us being able to sell directly to those data centers. So for example, in the listed fund, ORIT, we have a portfolio of solar farms in Ireland that sell their power directly to Microsoft, who have a lot of big data centers around Dublin. It's sort of the area around Dublin is very similar to Slough in that respect. The other thing we are looking at, and is within the Energy Transition Fund as an example, are sort of opportunities where we can provide more sustainable data centers. So perhaps not the massive sort of warehouse style ones that are being built by some of the AI companies, but for certain uses of data centers, you can have a sort of smaller center located quite near to the edge of networks where people are actually using computers, and also quite near to the edge of networks where people are using power and heat. So there's one company which has put data centers in a sort of oil bath next to a municipal swimming pool, and the pool effectively provides free cooling for the data center, and the data center provides free heat to the town swimming pool. and everyone wins. So there's a business called Deep Green doing that that's been backed by our Energy Transition Fund as an example.
That's how we used to have our swimming pool in the City of London heated. It was a laundry next door who heated the swimming pool for blokes like me when we were kids. Yeah, wow. Okay, that's brilliant. Thanks for that. There's a call from Peter Cameron Brown. Have you? Do you want to say that, or shall we just go to it directly?
I'm happy to have two comments. First was on the semi-liquid fund. I just wondered, is there a minimum investment tranche for an institutional investor at present? And it seems to be set up to allow subscription investing, but I just wanted to pick up on that. And secondly, while you're talking about it being semi-liquid, is that envisaged through a secondary market, or is that going to be within the fund itself? So I'll take that one first.
Yep, I'll pick that one up. So the minimum investment tranche is 125,000. So
very low.
Deliberately relatively low for institutional, but that's designed to make it accessible to wealth as well. And within that, that's for the wealth audience. We would see, so say a Rathbones or an Evelyn were pooling money from a number of clients and putting it into the semi-liquid fund, we would see the wealth manager as one investor for that. So actually, it really is quite accessible with that 125,000 minimum. And then on subscriptions and redemptions, so it deals monthly, and the existing Cornerstone, yes, they put 175 million in day one, but their monthly payroll is going into the growth phase of sort of active members' pension pots, and they are topping up from that every month. So we're up to nearly 200 million now just from repeated monthly top-ups, and so there's the ability for everyone to do that as well. On redemptions, so we are able to facilitate liquidity from within the fund. That's one of the reasons we have that allocation to roughly 20% in a portfolio of listed equities, but also the nature of the underlying assets in the private funds. There's a lot of very predictable cash flows coming from highly contracted operational wind and solar farms that are paying off a regular yield. So we have good visibility on income that we can use to satisfy redemptions, and if there aren't redemptions, just reinvest back into the funds. The underlying funds themselves also have certain liquidity provisions, and so we're able to manage liquidity within the fund itself. One of the tools within the fund is sort of secondary market transactions for the private funds, but we haven't got anywhere near needing to look at that. And in terms of what the liquidity is, I can't remember if we went through that detail, but you could redeem 10% of your holding every month and 20% every year. So it's not like we're having to deal with someone suddenly needing to redeem everything in one go. Clearly, if there are net inflows, we will facilitate a greater level of liquidity. So if someone wanted to pull out more than 10% in a month and we were in a net inflow situation, then we could do that.
All right. Yes, obviously cash calls and LDI and such like have influence thinking on that. But yeah, the second point I make was just a general point, picking up on Henry's point about the global reactions to things. Just pointing out, I was reading a very interesting article that appeared on BBC News this morning about the fact that electricity generation from renewables for the first time this year has passed that from coal and carbon and electricity generation across the world, and how that's affected in different countries, and particularly in the developing countries, the amount of well, depending on the country, the location of the country, whether it's in the sun belt or the wind belt, the growth in the renewables is very fast. Like in some countries, I believe they're saying the importation of solar panels has gone up 99% over the last year. So they're doubling their solar generation capacity every year.
So it's incredible the growth that has been achieved, and that's because the economics make sense. There are a couple of other questions. Just so I know we're racing through. There's a question about the ownership or where Octopus Energy is held. So we're part of Octopus Energy Group. Octopus Energy Group is a UK success story. I'm going to be one of the very few decacorns, technology decacorns in the UK. And we are as a fund management business, we're 100% owned by that. And clearly, the underlying funds are invested into by investors all the way around the world. I'd suspect most of them are UK investors that have come into it, but clearly we're raising a lot of money from Japan and Europe, and a bit from the US as well in there. You covered the BBC ORIT fund, David, 9.5%.
Yeah, that's right. So yeah, ORIT pays out a quarterly dividend. The annual target dividend for this year is, I think, 6.17 pence on a sort of net asset value of around £1 per share, but we're trading at more than a 30% discount to net asset value. So if you were to buy ORIT shares today, that 6.17 pence dividend does turn into, depending on exactly where the share price is, but yeah, 9.5% is about right for where the dividend yield is at the moment. So there's a compelling value opportunity in those, and actually one of the things we have been doing within the semi-liquid fund is acquiring shares in some of the listed renewables investment trusts, because they provide some liquidity, incredibly attractive dividend yield, and we would expect in the medium term that those discounts will narrow, whether that's sentiment improving or by take privates or consolidation activity, because the underlying valuations are not fairly reflected in the share price. So there's a real opportunity there.
Yeah, it's interesting on the NAV. So within ORIT, we've sold assets at or probably slightly above NAV, I can't remember, but
yeah, well above in some cases. Yeah.
So the NAV is a real NAV. So it's just an investor sentiment that means that they're not buying into that at the full NAV rate. So it's the same for other funds, we think, as we can sort of unpick their investments, knowing how to value these assets and seeing what they announce. It means we're well placed to see where we think there's going to be real value in those other investment trusts.
Matt and David, Elspeth is in fact Con Keating. He's got a question. He's also got a big smile on his face, which usually means trouble. So off you go, Con.
It's a really very simple question. The UK has the highest electricity price pretty much in the world. So my question to you is, how sensitive are your revenues to declines in the price of electricity here and more widely?
So, well, I'll start this, David. You can then give the detail. I mean, if you think about a high level, how we invest into a wind and solar farm, we get energy price forecasts from the leading forecasters around this. We don't make those forecasts up, and then gives you a price that you then discount back to get to a valuation. We take a blend of them. It's pretty sort of and those forecasts do assume energy prices are going to go down. So in those forecasts, and they assume there's going to be cannibalization. So at some point you're going to get zero for the electricity you generate. So at any point in time, the value of your asset, being the discount of future cash flows, reflects lower energy prices in the future as there's more rollout of wind and solar. A wider point is in the short term, there's clearly more volatility. As I'm sure you're probably aware, the marginal generator in the UK is gas. So gas sets the price for electricity in the UK and most European markets at the moment. Therefore, depending where the price of gas is, will dictate where your electricity price in the short term. Now, the UK has had higher gas prices. Actually, they'll come down because LNG will start coming through from the US over the course of the next year or two. They've set up their infrastructure outside. So we'll probably see lower gas prices, which means lower electricity prices in the UK. But these are all within the forecast. Forecasts are never absolutely correct. They'll be up or down, but it's not like we're going blind with a flat line. David, what have I missed in that answer?
I think a couple of things I'd add. So one is when you see the headlines on very expensive electricity bills in the UK, a significant component of that is the way that the system is set up. So a lot of the costs of all the wires, but also a lot of the costs of legacy support schemes, and a lot of tax effectively gets lumped onto electricity bills disproportionately, either to gas bills or to some other countries that recover it from general taxation. And so the price that we are selling the electricity from our renewables plants is only actually a surprisingly modest component of the bills that are being faced by consumers and industrials and commercial users. And then if you look at the actual revenue streams of our projects, the amount of contracting that we have in place, even for say a fund like Sky, the sort of private fund that we've talked about, if those forecasts that Matt described were, if we were just to replace that forecast with one that was 10% lower in every year, the value of Sky's portfolio would fall, but only by 4 or 5%, because we've got a lot of fixed prices in there. And then if you look at something like the semi-liquid fund, where we also have more exposure to other forms of revenue that aren't just selling power, that reduces that power price exposure even more. So yes, clearly the nature of what we do is that if power prices fall more rapidly than we have modelled, it is a drag on our returns, but it is significantly mitigated by a very high level of fixed revenues, particularly in the next 10, 20 years.
Peter's got another question about Baroness Altman's perennial worry, which is that investment trusts, investment companies simply aren't treated properly. And I know she's got some hope that she's going to get a change in the pensions bill, so that we'll see more money flowing into investment trusts from pensions. Have you got a thought on this?
So I think the issues that investment trusts have had more generally is definitely part of what we've seen within ORIT. But I think if what we've seen within ORIT mirrors what we've seen within the renewables investment trusts, what the renewables investment trusts have seen in terms of share price performance, particularly over the last 3 or 4 months, has been materially worse than the broader investment trust universe. I saw one of the brokers had a note out this morning actually that showed quite positive performance for investment trusts in general over the last quarter, but the opposite from the renewables investment trust. So everything that Baroness Altman's trying to do around cost disclosure, around sort of inclusion of investment trusts in certain parts of the pensions bill, I'm personally very supportive of. I don't think even if she's successful, that's going to sort of fix the renewables sector overnight, because there is, I think, a slightly different problem there, which is one of supply and demand. A lot of the investors in the renewables investment trust were wealth managers who have firstly gone through a lot of consolidation, so they want bigger vehicles. Secondly, can now allocate materially to fixed income, which just wasn't giving them any return 10 years ago when a lot of these vehicles launched. And so that sort of supply and demand needs partly resolving by there being fewer bigger vehicles in the sector.
Could I just come back? I'm actually concerned about the demand for electricity and the extent to which the demand forecasts I have been seeing are based on unending further investment in data centers. In the forecasts of revenues that you are looking at, what's the base case data center development scenario?
So I definitely don't have the precise, how many, sort of units of capacity or how many trillions of data centers get built across the world. It definitely has increased over the last 2 years, but it is generally not the case that the power. So, for example, if I move out of the UK and look at some of the announcements that have been made in the US around some of these enormous projects that OpenAI and others are looking at, those are not in the base case for these power price forecasts. And actually, if you look at the changes over the last 2-3 years in the demand element that relates to data centers and AI in particular, it is a significantly smaller component of the change in demand than either the continued electrification of small transport or the electrification of heat. And when we talk about the electrification of heat, that's not just assuming that people switch to heat pumps in their homes. That is part of it. But in places like Finland and Sweden, where we've invested in wind farms, there is already a huge drive for electrifying existing district heating systems that currently use biomass, electrifying industrial heat that currently uses, again, biomass or gas. And that shift to electricity in road transport and heating moves the demand forecast a lot more than data centers still, even with some of the hype about AI that's been going on in the last year or so.
Thank you.
Great, brilliant. Any other questions? Excellent session.
There is one from Bob.
Yeah, go on then.
Mr. Compton.
Henry, I'm just asking maybe a flippant question, but why is the UK electric industry marketing smart meters so hard and levying the marketing costs onto consumer electricity bills?
I mean, the smart meters enables clearly better visibility in terms of usage, and enables ways that the end user can start flexing their demand in ways that wouldn't be possible without smart meters. I actually don't know how much of the impact just the marketing costs on those smart meters would do to the electricity bills. I'm sure it's not insignificant, but amongst sort of the wider costs that gets added on, such as the the grid balancing costs, I suspect is pretty small relative to the rest of the bill. But I must have had a look at that.
John, you've got a very short question, I hope, because we're out of time.
No, it's just an observation on liquidity. With the inheritance tax charges of 40% coming in from April 27, you might need to address that situation. People will need full liquidity to satisfy their tax bill.
So one thing that is worth noting, again, if you take the example of our cornerstone investor in the semi-liquid fund, they have a scheme that offers liquidity on member death for the entire portfolio, and that the way this is all structured facilitates that, even for self-select. Some of that is happening at a level above us. It's sort of happening in the DC scheme and in their sort of contract with LGIM. But for investors like that, the expectation is having a holding in this vehicle doesn't cause a problem with liquidity on death.
Thanks very much. We do have to call it a day at this point. Thanks, Shay. And thanks to everyone who's been on this call. Thanks most of all to Matt and David. I found it really interesting. It's been a bit of a privilege. Back in 2016, one of my friends was the CIO at Legal & General, and he was offered, I think, Octopus as an investment. He said, that never was going to happen. He told me this. Yeah, were you there? Were you?
Yeah.
It's amazing how many good opportunities get turned over. I hope we are going to continue to do that. I'm pleased that you're doing so well now.
That's very kind words. Thank you. And
okay.
I know there was asked about slides. To the extent that people do want to hear more or get the slides being presented today, we obviously would be delighted to send those out.
Could you send them to Henry at HWage as well, and I'll get them onto a blog. And if you're not unhappy, I'll put your video on the blog so that people can see it.
Of course.
A lot of people do seem to go back over the years and check out what was said, so you're always witnessed. Yeah. Okay. Thank you very much indeed. Steve, have you got anything to say about next week?
No, we're going to be in conversation with somebody, but we haven't agreed who that somebody is yet, Henry. But we'll be in conversation with somebody next week. But I appreciate everybody's joining today. Hope you've enjoyed the session. Matt and David, thank you very much for your time. We'll put the video up in the next half an hour, and then we can share it on LinkedIn. Lots of virtual clapping from Peter. Thank you, Peter. And Bob, and great session. Thank you very much, and long may it continue. And it's good to see what you're doing in that space, and it will grow and grow. I'm no doubt. So
Thanks very much.
yeah, great work. Cheers, Matt. Thanks very much. All right, bye.